Hello there. I hope that you're doing well. Welcome to this first episode of the Zeussy 2025 Public Mentorship. During this mentorship series, I will share with you everything you need to know in order to understand algorithmic price delivery. During this mentorship series, I will share with you every single week around one or two lectures. These lectures will consist of either market reviews, trade breakdowns, or topical lectures. This lecture series is going to be the first series which I will ever release for my public YouTube channel, and therefore I'm very excited to release it for you. I look forward to hearing your response to this mentorship because I will provide to you the highest possible educational content which there's out there in the trading space. All I ask of you is to submit the time, meaning show up every single week, put in the work, and investigate what I tell you to investigate. And I'm telling to you that at one point it will click. It will all click. All the puzzle pieces will fall into the right place. And that is what I want you to have faith in, and that is what I want you to work towards. So, with that being said, let us begin with this first lecture of the Zeussy 2025 Public Mentorship. Before we begin with diving into this lecture, I want to first discuss the following topic with you, and that is walk your own path. What you will notice during this mentorship is that I will highly speak in terms of going against the masses, meaning where everyone is going left, I am going right. When everyone is leaning towards one side of the marketplace, I'm leaning towards the opposing side. And this is the personality which I have developed for myself. And this is also the way that I will teach you to look at the markets. But this goes beyond the markets. I want you to become an independent thinker. I don't want you to just go to the left because everyone is going to the left. No, you need to ask yourself whether or not going to the left is really the right decision to make. And then you need to decide if you are going to follow the masses or if you're going to go to the right and walk your own path. We're first going to take a look at buy-side liquidity. Buy-side liquidity is resting above old highs. If you pay attention to the chart screenshot attached to this slide, what you can see is that I've annotated this swing high right here. After this swing high formed, we saw the market drop towards the downside. We saw the market suddenly be repriced towards the downside. During this run lower, a lot of retail-minded traders are thinking to themselves, oh, the market is very bearish, so we should go market short. Where do they place their stop losses? They place their stop losses above the swing high which formed. Therefore, we know that sellers have put their stop losses above the swing high, and in order to get out of a sell position, there's a buy stop which is being placed. Therefore, this liquidity type is called buy-side liquidity. Sellers' their stop losses are placed above old highs. In this case, this high. What you can see is that once this high was taken out, I went short above here and I rode the market lower. I will explain more on this soon. Sell-side liquidity. Sell-side liquidity is resting below old lows. What you can see is that I've annotated this swing low right here, which set up the run higher into our buy-side liquidity pool objective right here. When the market took out that buy-side liquidity pool objective, I went short targeting this sell-side liquidity pool objective. If you want to see my trade execution, it's the video prior to this lecture. Sell-side liquidity is resting below old lows. Why is this liquidity type called sell-side, you might be wondering? Because in order to get out of a buy position, your stop loss is called a sell order. That's the order type. Therefore, sell-side liquidity has been engineered below this swing low, because whilst the market is running higher like this, every single retail-minded trader is thinking to themselves, alright, we should be buying right now. Where do they place their stop losses? They place their stop losses below this swing low right here. And before we continue with this lecture, I want you to understand that the information which I'm providing to you works across all markets, meaning it's universal. Even though I personally trade the index futures and specifically the Nasdaq, it doesn't mean that the information that I use only works for Nasdaq. No, it also works on Forex. It also works on commodities. And therefore, please do not think that simply because I'm a Nasdaq trader that you should only think that this works on Nasdaq. No, you will see these algorithmic signatures on all markets. The reason why this works is due to IPDA. IPDA is the interbank price delivery algorithm. IPDA is designed to deliver price in an effective and efficient manner. Its signatures can be recognized in real time on the markets, meaning the reason why I'm paying attention to these different types of liquidity is because when I know that the time is right, I can anticipate what the next draw on liquidity is going to be, what the next level is going to be that IPDA will reprice towards. Notice that I'm not saying that it's buying or selling pressure, which is the reason why price is going up and down. No, I believe that there is an algorithm in control of the delivery of price. I refer to this algorithm as IPDA. IPDA moves from liquidity to liquidity, meaning IPDA reprices from buy-side liquidity to sell-side liquidity, or from sell-side liquidity to buy-side liquidity, meaning when we recognize that buy-side has been taken out, the next logical draw on liquidity is sell-side liquidity. When sell-side liquidity has been taken out and we see what we're looking for in order to confirm a reversal, the next logical draw on liquidity is buy-side liquidity. This is how IPDA moves from old highs to old lows and from old lows to old highs. Our job is to recognize when the time is right for this to take place. This process is referred to as a purge and revert, meaning when one side of liquidity gets purged, we can anticipate that IPDA is going to revert towards the opposing side of liquidity. Our job is to recognize when the time is right for this purge and revert to take place. Because when we understand that the time is right, we can logically anticipate what the next delivery function is likely going to be. When we pay attention to that same chart example, you can see the following. What you can see is that after this drop lower took place and buy-side liquidity was engineered above this high, we saw the market form this swing low under which sell-side liquidity was engineered, and we then saw the market run up higher, drawing towards that buy-side liquidity pool. When we took out that buy-side liquidity pool right here, you can see that I've annotated this box right here in gray. This box is representing to you the purge on liquidity. The purge on the buy-side liquidity resting above this high right here. The fact that we then saw a reversal taking place, drawing towards that old sell-side liquidity pool, that old low, shows to you that this was a purge of buy-side liquidity followed by a revert towards sell-side liquidity. And now notice that I have not included anything with regards to time into my analysis yet. Now the reason why the purge and revert falls in line again with that first image which I've shown to you at the beginning of this lecture is due to the following. When the market is running up higher like this and you see these big green candles especially form right here, what are the masses thinking? What are the majority of traders thinking? They are thinking, oh, Nasdaq is going to be repriced towards the upside, is going to run up higher. I need to be market long now, right? They are chasing these big green candles. But we understand that this is exactly what we are looking for. This is manipulation which is taking place. And after manipulation has taken place into a point of interest, into this buy-side liquidity pool, we can logically anticipate that when the time is right to the minute, that we are likely going to see a reversal taking place so that the market can draw towards the opposing side of liquidity, in this case, this sell-side liquidity pool. And what you see take place afterwards is the following. You can see that the market drops lower below that sell-side liquidity pool, and you see these big downward candles form. So what are retail-minded traders thinking now? They are thinking to themselves, oh, the market is very bearish now. We should go market short. And what is securing? You can see that the reversal forms and the market draws towards buy-side liquidity next, engineered throughout this run towards the downside. So what you are seeing is that initially they trapped buyers up here, and then the market ran on lower. Then they trap sellers down here, and then they run it up higher. Do you see how many opportunities there are each day? Within this one schematic, I can literally point to you countless trading opportunities. What you will learn during this mentorship is that there are a lot of trading opportunities each day. Our job is not to participate in all those opportunities. Our job is to recognize the opportunity which makes the most logical sense to us, and that is the opportunity which we are focused on. I don't care about all the Mickey Mouse moves in between. All I care about is the opportunity which I see coming hours in advance. Meaning, my private mentorship students knew that for this day, I was leaning towards a sell-side liquidity pool objective. Therefore, this whole run higher to me was very suspicious. This to me was all the engineering of sell-side liquidity. Because when the market runs up higher like this, I'm thinking one thing, and that's the following. I am thinking, all right, it is time for the market to run towards all of that engineered sell-side liquidity soon. All I need to wait for is for the time to be right, and then IPDA will reprice lower. Now, what you will learn during this mentorship is that there are a lot of trading opportunities each day. There are a lot of opportunities to get in and out of market moves. However, does that mean you should be trading multiple times a day? Does that mean you should be behind the charts from 9:30 a.m. until 4 p.m.? Absolutely not. I want you to focus on the opportunities that make the most logical sense to you and that you can anticipate coming hours in advance. Those are the bread and butter setups. Those are the moves I am interested in. Do you think I care about anything else for the remainder of the day after I made nearly 10 times what I risked on this position? Because that's what occurred. I made 10 times what I risked on this trade, which is right in front of you. Yep. That is the power of the information which you will learn during this public mentorship. Will there be things that I will not teach you? Yes. There are certain things which I'm not sharing publicly. And you can argue with me all you want. You can basically be upset about that. You can be mad, but you can also just view it as, all right, I'm happy with what you're already sharing because this information is already priceless. Because all I'm sharing with you now is price. I haven't even discussed time with you yet. And this is an introduction lecture. Let us discuss narrative. Narrative is the understanding why IPDA should do something. The why is very important. Why should IPDA reprice towards that old high? Or why should IPDA reprice towards that old low? Narrative is understanding the underlying logic behind the why within these questions. This answer is based upon an understanding of time and price. And therefore, it isn't as simple as, oh, we take out that old high, so now we refer to that old low. No, there must be a reason for the market to take out that high to then draw lower towards sell-side liquidity. When we pay attention to the example again, what you can see is that I've annotated vertical lines at 9:30 a.m. at 10 a.m. right here. Next to that, I've annotated the 9:30 opening price. What I will teach you now is looking at opening prices to determine true premium and discount. What I want you to see is that from the 9:30 open, the following occurred. We saw the market drop lower and this low formed right here. We then saw this sudden repricing higher taking place and the market was in a run to go higher, as you can see. This swing high formed and we saw the market suddenly drop towards the downside. Now let me explain why this run higher is so important. What is occurring during this run higher? During this run higher, retail-minded traders are trapped into believing that we are going to see a very aggressive upside day, meaning they are chasing the market long in this area. After this swing high formed, you can see that the market runs on that engineered sell-side liquidity, meaning below this low, sell-side liquidity was engineered. That low gets taken out and we see a new low forms. This low sets up a new run towards the upside. But why is this run towards the upside so important? Because at 10 o'clock, we have high impact news. This 10 o'clock high impact news is very important because volatility is being injected at this time into the marketplace. What you can see is that from 10 o'clock, the market initially drops lower And then we see this sudden run higher taking place. These big green candles form. This is again the engineering of sell-side liquidity. Why? Because retail-minded traders, they view this run higher and they think to themselves, oh, the market is going to expand towards the upside. I need to press market long now. I need to just chase the market now because they are fearful of missing out on possible expansion higher. We, however, know that relative to the 9:30 open, the market is in a deep premium, meaning after we traded above the 9:30 open, you can see that price never trade below it again. So who has been making money all this time? Have sellers been making money or have buyers been making money? Buyers, of course. Therefore, when the time is right, IPDA will seek to reprice towards the stop losses of all these buyers. And those stop losses come in the form of sell-side liquidity. So when after 10 o'clock, this previous cycle high, this buy-side liquidity pool gets taken out, previous cycle high, what is that? Time cycles. I've already discussed this in 2024, but I will explain this later down within this 2025 mentorship more in depth because time cycles are the reason why the market reverses after having taken out a specific liquidity pool. So that is going to be a very important topic for you to investigate. But for now, focus on the topic of liquidity. What you can see is that the market takes out that buy-side liquidity pool. We then see that reversal taking place and the market runs lower. It trades below the 9:30 open price and it forms a new low for the regular trading hours, which begin at 9:30. So what has occurred is that initially buyers have been making money. After that, sellers have been making money. And what occurred afterwards is that they ran it up higher again. Why? Because during this leg lower, sellers are making money and therefore buy-side liquidity is engineered above this high, above this high, above this high, etc. And that right there shows to you that there are countless opportunities to utilize the concept of liquidity to frame trade setups. Now, notice how I've utilized opening times and the logic of time cycles in order to justify why the market should form a swing high here and why it should draw towards lower prices next. It's a result of understanding the question or the answer to the question, who has been making money? Because buyers were making money all this time. And when I recognized that the time is right to draw towards these buyers as stop losses, I can short the exact high, and that is what you're seeing here. I don't want you to think that you are going to be able to do this as well, because you are years away from getting to this level of precision if you're ever going to even achieve this level of precision. This requires a lot of understanding of IPDA, and next to that, it requires a lot of experience. Focus on capturing the logic sell which is taking place in this area. Don't focus on entering within the smart money reversal. What I want you to do is I want you to go into your own charts and I want you to investigate these type of movements where you see the market trade above an old swing high and then revert towards the low which set up the run higher into that high, where you can see that the market takes out an old low and then draws towards the high which set up that run into that sell-side liquidity pool. In this example, this high set up the run lower into this low and therefore monitor whether or not the market is drawn towards that buy-side liquidity pool again moving forward. With that being said, this first episode of the Zeussy 2025 mentorship comes to an end. I hope that you found it insightful and I look forward to speaking to you in the next one. Good luck with your studies and be safe.